Well, it's Thursday, October 19th, and mortgage rates inched over 8% today for the across the average. We've been, for the last few weeks, I know mortgage folks that I've been talking to have been often quoting 8% rates to home buyers. And it's no secret, it's a very tough real estate market. Is it frozen? Like, I've used the adjective frozen, but at the same time, I know a couple of people who opened escrows this week. So maybe it's not entirely frozen, but what we're going to do today is look at all the signals and see nationally all the trends that we can take, and what to watch for next to know about inventory trends, home buyer trends, prices. What are prices going to do in the foreseeable future? We're going to tackle all those things today. And of course, Altos Research tracks every home for sale in the country every week. We analyze all the pricing, all the supply and demand, all the changes in that data, and we make it available to you before you see it in the traditional channels. So we're going to go look at all of the pieces today. I have, as always, we have Jeff and Lael from the Altos team that are in the chat. When we talk about I make some references to some links, to some Q&A. You can use the chat. Jeff and Lael will be in the chat trying to answer those things as quickly as possible, as best they can while we're talking. And we're going to close today. Of course, what we always like to talk about the local markets. There's some really interesting stuff in the local markets happening. So we'll finish there, and then I will stick around a little bit in the chat to make sure we get any of the questions done at the end. As always, everybody who's registered for this event will get the recording of it, so you'll get that later in the day. Look in your email for the follow-up from this session. It's always recording. It's on our YouTube channel, so you can also watch it and share it with other people. Okay, inventory is still on the rise. What does it mean? What do we know? What happens next to home prices? We're going to look at the pendings and the sales trends that we can see right now too. We'll close with the local markets behaving differently. And as always, I will try to frame the conversation so that when we are talking with people who are interested in the market right now, buyers and sellers or investors, or people who have exposure to real estate, everybody has an opinion about what's happening in the market. A lot of people are afraid. And I like to say that the data is the antidote to the fear. So if we're going to try to frame all the conversation with that, the ability, how we talk about the data with buyers and sellers right now. A lot of people are on the fence. A lot of people are waiting. So what are we going to say? Before I dive into the data, though, if you haven't already downloaded the free Altos ebook, How to Use Market Data in Your Business, I recommend that you do so now. There's a link in the chat to go click through and download that. It helps you to talk about the data, the same data I'm talking about here, and common questions that home buyers and sellers have, and what they need to look at, and what does it mean what do price reductions mean, or how do we talk about all these data? So that's all written in that ebook. I recommend you go download that now if you haven't already done so. All right, let's look at some data. Let's start with inventory today. There are 546,000 single-family homes available unsold on the market right now. It's middle of October, and the inventory is still climbing each week. It has not yet plateaued and started ticking down. Usually that plateau happens in July or August, and by October, we're well past our peak of inventory and just about to start the real decline for the holidays. You can see this chart is multiple years of inventory, the curve that happens each year. Right now at 546,000, we're less than half of what we were, 6, 7, 8 years ago on the market. But at the far right end of the chart here, you can see Inventory is still ratcheting up. Last year, the peak so we have slightly fewer homes on the market now than last year, a few percent fewer, but the peak was October 28th. So two more weeks of readings before the peak. As it is right now, I don't like inventory could continue to grow into November. I haven't seen any slowdown in inventory growth yet. And that, of course, is due to higher mortgage rates, right? Has really put the brakes on home buyers. So we have fewer buyers each week, fewer homes going into pending. Those are sitting on longer. And so any folks who are listing homes right now they are adding to inventory each week. I have what we want to do is think about how mortgage rates are impacting that current supply and demand scenario. So supply is growing, and it's really not because of sellers hitting the market. It's really because the buyers have slowed. So you have a slower than normal rate of sellers, and you have even slower buyers. So inventory is building, and as of right now, rates are still on the rise as of today, and so it doesn't show any sign of turning the corner for the rest of the month, the quarter, or even now we start looking into 2024 and what's going to happen to inventory. And it's really going to depend on what rates happen. I've looking at the same inventory chart here now is overlaid with mortgage rates. So the black line here is the same chart we were just looking at. That's inventory. And the question that we get and that home buyers and sellers are asking is, when are we going to get more inventory? What makes more inventory? The short answer is more inventory is from higher rates, where lower rates will lead to less inventory, tighter supply. There's conventional wisdom. A lot of folks are thinking that once rates come down, then we'll finally get some inventory. But the data shows that the opposite is true. So the colored line here is mortgage rates over time. Rates crossed 8% today. And what we can see is back in 2018 on towards the left side of the chart, mortgage rates rose from like 4% to 5% in 2018. Inventory rose from January of 2018 to January 2019. Rates then fell for several years, and rates fell dramatically in 2020. Inventory fell dramatically in 2020. Rates spiked last year, and inventory spiked last year. Rates peaked last year, first week of November, and started coming back down from 7.5 into closer to 6. And what happened was the first half of the year, inventory responded as well. And that was a surprise to me, how quickly inventory started falling. And year over year, we had less inventory in the middle of the second quarter than we did in last year. And that's because rates fell from their peak of 7.5 to back down to 6s. Now, though, in the last several months, rates have been rising pretty steadily from 6 now to 8%, 200 basis point move. And as a result, inventory is climbing. So if you have buyers who are waiting, and there's a lot waiting, they are obviously and should be waiting. Like, payments are more expensive right now, and they're hoping to get cheaper payments in the future. They're hoping that rates will dip back down and that we'll get cheaper payments next year. The downside of that is that when rates fall, we will spur demand. We will not spur supply as much, so inventory will fall. So while you're waiting for lower payments, you're also going to experience less selection, like we had this year. So we had selection peaked last year and then fell again when rates fell. We have our inventory has built as rates have climbed this year. over time, multiple years, if we're in a space where we have multiple years in the sixes, sevens, and eights, that will allow inventory to build back. It took us a decade to get down to these record low pandemic levels, a decade of really cheap mortgage rates. And so then multiple years of higher rates will help inventory build back up so selection gets back to a more normal level. So that is the expectation on what's going to happen. When will we maybe get more inventory? There are other things that could imply that get us more inventory in the next 2 years. If the economy slows, right now we're really at full employment. Some of the signals of employment are starting to weaken. And so do we get a job loss recession in, say, the first quarter or the second quarter next year? It's really another year after that, so mid-2025, before we see inventory that would come from a job loss recession, if it starts right away. If the recession really kicks in the first quarter or second quarter next year, then we would see it mid-2025. If we get lucky and we have a soft landing and we don't see the job loss recession, then that inventory is like, there's no distressed inventory that needs to come at all. There may be, and we can see a lot of this maybe right now, is that investors who are currently slowing their purchasing because cost of money is higher, if there is a point where investors feel that economy changes or rents drop, and so then they need to unload the investment properties that they've had, that they've bought through the last decade, that could add to inventory. The important thing about investor inventory coming to market, the important thing to keep in mind, is that there is no sign anywhere in the data of that happening yet. So the investors are sitting, especially in the single family space, are sitting on ultra cheap locked in mortgage rates. Also in the apartments, it's very different. And so there's definitely a churn in apartments happening, like big multifamily apartment buildings. But especially in the single family side, there is no sign of investors or Airbnb owners or anybody who's like rushing to sell their homes. There's no sign of it anywhere in the market. So it could happen, and it could happen in a change of economy. It is something we want to keep our eye on. But your buyers and sellers may have a hypothesis. They're like, you know what, as soon as the economy turns, we're going to see a flood of inventory, and then I'm going to swoop in and get my bargain. The key for them to know is there's no sign anywhere in the data of that happening yet. So higher rates lead to greater inventory. Lower rates means it's more affordable to buy, more people buy, and hold. So we'll have less inventory. And that's really the lesson here. And I've got the arrows that show when rates went down, inventory went down. Rates went up, inventory went up. It's really, really tightly correlated. All right. So let's look at where inventory then we're projecting for the end of the year. I've used this slide all year long. When we started the year, we were coming off the fourth quarter, which was very slow last year. And we were projecting that the dark red line here would maybe get up as high as 700,000 single family homes on the market. With a much slower year this year. What we experienced is that rates dripped from 7.5 back down to 6, and that spurred demand all the way through the second quarter this year. And so inventory dropped all year, and each line on this chart is a year. And so you can see the dip in the first and second quarter, and then usually peaks in August and then curves back down by the end of the year. What we're at now is we're looking like we're going to peak maybe in November this year. So the whole curve has shifted later, and it's shifted later with mortgage rates. The shift happened last year at the first week of November is when mortgage rates peaked and started coming back down pretty quickly. But right now rates are still rising. And so the dotted line here is a forecast for the rest of the year. And it looks like we're going to end up inventory over 2023, over 2022. So with like 522,000 single family homes. So the forecast is still to climb for several more weeks before we get a holiday decline, and not as nearly as steep as a holiday decline as in normal years. So then in probably by November, we'll start forecasting out what 2024 looks like here. And it's really going to depend on what you think mortgage rates are going to do. As I say, at Altos, we don't forecast mortgage rates. I don't personally. I've been wrong on my mortgage rate guesses for 30 years now. And so I don't know where mortgage rates go. There's a lot of scenarios. A weaker economy could imply cheaper rates. Stronger than expected economy could imply stronger rates. Wars, where it's a flight to U.S., could imply higher rates. Like there's a ton of variables that I don't predict. I don't have an ability to predict. And so we don't know where mortgage rates are going to go. What we do know, if rates stay higher for longer, that implies more inventory. If rates fall, that implies cheaper payments, but more demand, and therefore less selection for buyers. Okay, so let's look at the demand side with the supply. So I mentioned that there's no flood of sellers. There's no investors panicking. There's no Airbnb sellers. There are very few sellers around the country right now. This is a chart that we do with our immediate sales. And immediate sales, remember, are the ones that get listed and then take offers, within hours or days, a couple of days, and they go into contract essentially immediately after listing. The immediate sales was this phenomenon that we had during the pandemic. Things were going on. We had multiple offers right away. We had stuff that was coming soon. And so the offers were already in the bag when we listed the house. All of those, that was really a phenomenon of the pandemic. Then last year, it stopped dramatically, very quickly. And so the way we have the chart here is each week is in the chart here is each bar are the new listings per week, the total new listings per week. The higher the bar, more sellers that we had at any given week. The light portion of the bar are those immediate sales. So some of those new sellers went into contract immediately. And what you can see here in the middle of the chart is last year that sales rate stopped first week of July, and the sellers held back, went way back, and then the shrinking light part meant the buyers were pulling back too. We no longer have the multiple offers, and they sit a little bit longer, so fewer immediate sales. And what we can see, the dotted line is where we are right now, and so you can look. Normally, this is like November levels, or way during the pandemic, way more sales happening at any given time. And so really, though, what we can see is a much slower decline on the sales rate and the listing rate than we had last year. Last year was still very much adjusting out of the pandemic and coming back down. We're about to enter the holiday months. And so, the new listings for November and December obviously drop, and you could see the Thanksgiving and Christmas weeks are the two really short bars here. And then you start in January and they start picking up again. So what this tells us is that this is one way to look at whether there's a flood of new sellers coming. So if those sellers are coming, that the dark part of that bar is growing, the height of the bar is growing. And if none of the people are buying them, then the light portion is shrinking. And so that's what we're looking for in the data to see if there's that kind of shift happening. As it is right now, what we see is supply and demand that are both low, and not undeniably low, right? It is not there's no measure of a strong market here, but what we found is that the low levels of supply relative to demand has really been one of the things that's kept the floor on prices this year. There's enough demand for this very, very small level of supply. So that's the immediate sales. If we look at the immediate sales as a percentage of homes, so like this is how tall that light part of the bar is versus the whole bar, and meaning, back during the pandemic, 35% of the homes that were getting listed were going into contract immediately. And that dropped dramatically last year. And so when this line falls, that is showing us that less urgency to buy. It's showing us less demand. It's showing us less multiple offer scenarios. And so the dotted line across here is maybe 25%. In recent years, 25% of those homes are going immediately, but we're down into the low teens now. And you can really see how the higher rates started basically in May, and how that has curbed demand all at the right end of the chart here all year long. And so this is one way to show that. So again, obviously for buyers, there's fewer buyers happening. They're less likely to bid. We're less likely to overbid. When rates are at 8%, every dollar I'm overbidding matters. When they're at 2%, I can overbid and not worry about much adding to my payment. So all of those are factors right now. And so this is really just, here's what we see. We could see in the first half of this year, the immediate sales as a percent kicked up. And this is what I was talking about, where when the payments are falling, your competition is rising. And so that's a factor that buyers should be aware of. If we look at the new listings per week, so then these are now per year. So each line here, each color is a year. And so, we can see how we have record few sellers each week. The dark red line is this year. It was falling dramatically last year, the bright red line. And so there's no sign anywhere of like a surge in sellers. Last year, in the squiggles in the middle of the chart here, the bright red line was climbing. That was in the second quarter last year. Anybody who was thinking of selling was pulling that forward into the second quarter. And you could see that the new listings rate was climbing there. That's not happening right now. And so again, this is a signal about where we are and why there's stability in home prices, right? There's a supply and demand stability in home prices, and it's not just low demand. And the real crisis scenario, the real fear is if demand falls like it has, but supply climbs. And so that's the scenario that we're always keeping our eye out for. Are sellers coming to market? Are we getting out of balance? Because those would then have bigger implications for future sales prices. And what happens right now at 8%, and that mortgage rates have, they were at 6% a few months ago. So that 200 basis point move in a few months is a big deal. And so that's what we got to keep our eyes on in the data each week. All right, let's switch to the sales side. So these are pendings. And what we've got here is each bar is a total number of pendings, homes in contract. And this is single family homes. The light portion of the bar here are newly pending in a given week. A healthy market might have 80,000 or 70,000 or 80,000 new transactions each week. Right now we have 52,000 this week. This is really low. The total number of pendings is holding steady. It's not, there's 326,000 single family homes in contract right now. Last year it was 351K. And, before that in 2021, in the heart of the pandemic, there was like, 400,000 or 500,000 single family homes in contract. And so significantly fewer homes in contract. And no, these are the homes that are in contract now. They will generally close in November. We'll start seeing that recorded in December. And so we can see through the end of the year that there is no resurgence yet in the home sales number. By the way, NAR released their seasonally adjusted home sales rate. I think it was today, and it's under 4 million now. And you can see it here right now in the data that it's not going to, we're not going to get better. There's no sign of an improvement in the next few months until maybe first quarter, right? So the sales that are happening in the first quarter may, if rates ease down and we see that demand pick back up, then that's when we would have a change in that sales rate. But because it hasn't happened yet, there's no signal in the data of any increase in the current in the new sales each week. The little dashed line across the middle, you can see how much fewer sales we have in the inbox than we had in recent years. You can also see here that the seasonal decline this year is slower than it was last year. Last year, the brakes were getting hit from the frenzy. This year, it's a much softer decline. And again, this speaks to our balance of the supply versus demand. Neither of them is getting out of whack here. They're both settling at very low levels. If we look at the days on market here, I've got the wrong title on the slide. It's days on market is at about 1.5 months right now. It's the same as last year, which is interesting because you could see the days on market was climbing last year really quickly. And so this year it's much more slowly. Again, this speaks to the sort of balance of supply and demand. There are well-priced homes in the desirable areas that are getting contracts immediately and very quickly. And so those are keeping the median price down, the median days on market down but if things are overpriced or they're, the weird ones are much harder to sell right now than they were during the frenzy. And so that is what keeps the days on market heading higher right now. All right, let's switch to pricing. The median price of single family homes in the US is $439,500 right now, this week. That's pretty steady for the last few weeks, tick just down a notch in the last couple of weeks. Home prices are a couple percent higher than last year, and they're holding up better than last year. So you can see the slope of the line, of the dark line here, was dropping rapidly last year. Home prices peaked lower. The peak of the July peak was lower than last year, but then in the second half of last year, the prices were dropping more quickly. So what that tells us is that even though demand is super weak right now, that year over year home prices are up 1%, 2%, 3%, and that they will finish the year up that same amount, couple percent over 2022. That was a big surprise compared to when we started the year. Like this point last year, we were expecting home prices to finish negative year over year, finish lower year over year. And, when we got to July, they were negative. The July of this year was a couple percent below July of last year. But because home prices fell dramatically in July and October last year, that means that the annual comparison is. So the headlines are actually going to show home prices are up year over year. And that's going to be distressing for these buyers who are like, I'm just going to wait till things get cheaper. They're going to see the headlines for the next several months, 4 or 5 months, that say home prices are up year over year. And they're like, how can that be? Because we know that demand is way off. So it's just, but it is because the comparisons to last year are much easier, and the balance right now, sellers are much less surprised than they were last year, right? So they're pricing better going in forward, and the buyers are buying at the rate. The total supply is so few that there's enough buyers to keep a floor on that. Now that could change at 8% mortgage rates. If 8%, we stay over 8%, we go higher from here. Maybe we start to see an imbalance between sellers and buyers, and therefore prices start to adjust down. But the sales headlines that we're going to get for the next couple months are going to talk about home prices are up year over year, and it's going to be really distressing for buyers. And so being able to communicate to them that, you know, they're up year over year because last fall was adjusting quickly might be a powerful reason, like a powerful way to communicate. It's not that they're but the message is that home prices are holding up because there's a balance between supply and demand. The median price of the new listings is also up from last year at this time. It's a little higher, a couple percent higher than last year at this time. So that's the bright red line. And you can see that it's also not falling as quickly. Now, the median price of the new listings is a leading indicator, remember. So it is a really great expression of everything that the sellers and the listing agents know about the active market right now. Like, you look around and you know if at 8% rates, if somebody went into escrow down the street, or if they've got nobody at the open home. And so if you've got a new listing right now, you know exactly where to price it. If there's nobody at that open home, you do a little discount. If the one down the street went into escrow at this price, you know exactly where to price it. And so the price of the new listings is a leading indicator. If sellers and listing agents start to see that 8% has really put the brakes on all of their bids, then the new listings are going to ratchet down like they did last year very quickly. And so that will be a leading indicator for those buyers who are on the fence to say, look, as of right now, the new listings price is holding up. And that's because there is enough buyers for this tight level of supply. But we're going to keep our eye on this every week. While you're shopping, I want you to look at this price of the new listings every week. I'm going to put the report in your inbox every week. And I want you to watch this because that's our leading indicator for where home sales prices are going to be in the future. House gets listed now. Maybe it gets an offer in November, it closes in December or January. And so then you start hearing about those sales prices in January and February. But we can see right now with the price of the new listings that there is resiliency in pricing. But we're going to keep our eye on that each week, especially with rates at 8%. Now, if we look at that new listings price year over year, so each line here is now a year, each color. And you can see how earlier in the year, the dark red line was lower than the bright red line. We were comparing to the first half of 2022 was hard. Comparing to the second half of 2022 was easy. So you can see the dark red line, the 2023 line is up, where the bright red line was declining pretty notably last year at this time. And again, this is why we know that the sales rates for the end of the year are going to report positive over home price gains over the previous year. Even though everybody feels like the mortgages are expensive, demand is off, the headlines are going to read home price gains. And I think that's important to be able to communicate to your buyers and sellers, because especially if you communicate that before they see those headlines, like that is a market expert communication technique. Prepare yourself that the headlines are going to report home price gains over last year, even though we're in this crazy market right now. Let's look at the price of the pending sales. So this is the homes that are in contract and the ones that are going into contract every week. The dark red line are the new contracts each week. And what we can see is last year in June and October, home prices ratcheted down very quickly with the cooling market. In this year, the dark red line has a slower decline. And so the median price of the newly pending homes, so the homes that people are buying right now, is $368K. When rates are at 6%, like they were earlier in the year, then people are buying at $390,000. a year and a half ago, when rates are at 3 or 4%, people are buying closer to 400,000. You can really see exactly what the homes are that people are buying right now and where the demand is. So at 368K, declining slowly, and it'll be really fascinating to watch, the homes that people buy over the next few weeks with rates in the 8% range. The light red line is the price of all the homes that are in contract, and you can see that again, the peak of the year was below last year, so we haven't yet gotten back to the 2022 peak in home prices, but our gains, we are higher over where we were in the fall of last year. So last year the prices had adjusted quickly already. This year they're just slowly ticking down. So these are the pending sales and the newly pending each week. All right, let's look at price reductions, and then we're going to switch over to the Altos reports and the local markets. Price reductions, again, each line here is a year. What we can see now is the dark red line is starting to go from 35 to 40%. 38% of the homes on the market right now have had price reductions. A normal level right now would be 35 or 30%. And that means that more sellers are taking price cuts than thought they were going to have to. That is a real clear indicator of demand weakening. And as rates get into as price reductions get into the 40% range, like they were last fall, and then we can see really bearish indicators. The sales prices will be lower and, start looking like they're ticking down year over year. I looked this week at there's the various folks that forecast home price gains for the future, folks like Zillow and CoreLogic and Freddie Mac and the different MBA, the Mortgage Bankers Association. They all at this point have positive home price appreciation forecasts for 2024. Zillow is the highest at like 4.9%, which was released a few months ago. And my suspicion is that Zillow calculating 4.9% home price appreciation for next year relies on mortgage rates coming back down into the 6s and maybe even the 5s. So if rates don't come back down, if rates stay in the 7s or 8s, I think you'll start to see folks forecast negative home price appreciation for 2024. And we can see that first in the price reductions. So the house is on the market now. It doesn't have an offer. It takes a price cut in November, and then it finally gets an offer in December and it sells in January. We can see right now the price reductions are starting to happen. And so if they nationally start getting over 40%, like that's really bearish for the sales prices later in the year. Last year, the bright red line, that price reductions really accelerated in the second and third quarter, and then they kicked up again when rates jumped to 7.5% in September, October, November last year. And so we're in this range right now where they're starting to tick up again. And again, that'll be really, we're in this bearish territory, meaning that there are more homes that are taking price cuts than normal. And so that bodes bearishly for home prices in 2024. So you can watch price reductions over the next few weeks. And if they continue, if they get over 40%, I bet you're going to start seeing many of those home price forecasters start revising their takes for 2024 lower. And we'll see how quickly that the spiking mortgage rates really impact. And we can see them. The sellers are noticing it now because price reductions are still ticking up. Normally, price reductions curve back down starting in November because now it's the holidays. If your house hasn't had any offers, very often you do a withdrawal, you take the house off the market, and then in the first quarter you get fresh inventory, which don't do price reductions. So it curves back down. So the peak of price reductions is typically right now. Last year it went much later into November, and that's what, what the bearish signal is. So that's what we're going to keep our eye on with price reductions. What we'll do next is switch over to some of the local markets. I'm going to go into the Altos system here. I am looking at the Altos system, and this is my account for the national. In Altos, we have market reports for every zip code in the country, and my account I have for every zip. But you can also in your account, when you have your reports, these are branded for you and they have them for your zip code, and you know who's reading your reports from where and who you need to contact. We have our contacts database, and we can see where the new leads have converted, and we can see where they are, how many people they are open. The campaigns are the email campaigns that we're sending out. I'll let my contacts load here. I can see all the new leads I've got this week. And then we're going to go to the advanced analytics, though. Advanced analytics, I've got a few things. This is my dashboard where I am looking at a bunch of things. We were just looking at price decreases, so let's start there. Austin, Texas, right now has the most price reductions anywhere of any big market in the country. We were just in Austin this week for the Housing Wire annual conference last week. And I shared a few things about Austin when I was there. So right now, Austin has 55% of the homes on the market in Austin have had a price cut. And that is significantly more than normal. It's cold. It bodes for price decreases soon, coming into like the home price negative year over year in Austin. We can see, though, that last year in October was at 60%. So slightly fewer homes have had price reductions right now than last year at this time. Now, that's maybe small consolation because still over half the homes taking price cuts. And so you can really feel that. If you were on these calls earlier in the year, you noticed that last year at this time, the Western US, Austin, Denver, Colorado Springs, Salt Lake City, these guys were all last year were leading the price reductions. Then this spring, the Western markets recovered more quickly with cheaper rates, and the Florida markets were dominating price reductions. Now, though, the Western US markets are back up. So you can really see the volatility in the Western markets. Demand backs off very quickly with affordability and jumps back in when rates recover. And I'll dive into Austin and Denver and a couple other markets when we do the locals. This is an interesting chart for Austin. I built this. So this is available inventory, unsold. This is the Austin Metro. This is 11 years of inventory trends. And Austin is maybe the only big city in the US that has more inventory available right now than any time in the last decade. Really fascinating. The little dots on this chart are each year at this time. So you also see that normally inventory is falling by this time of year, and still maybe it's just reached its peak in Austin right now. It's a really notable thing because look, we can look at Denver or Dallas. It's not all Texas markets, it's Austin in particular. This is looking at inventory in that yearly chart. And what I've done is I've got 17, 18, 19. I've pulled out the crazy pandemic years, and now we're at 2023. And you can see how we are still in Dallas, still way below normal inventory levels, but still climbing right now. So you can see that higher rates are trying to get inventory back to its normal level as demand weakens in Dallas, but still supply is significantly lower than any recent time. The other thing that I was noticing is I've got a days on market chart way down here where we can see New Hampshire, Rhode Island, Wisconsin. You can see the Northeast and Midwest markets are the faster time to sell. And as we go down, Now we go further west, Nevada, Oregon. You can see the Texas, Wyoming. You can see the Western markets are much slower. Although Louisiana, Hawaii is always in its own orbit, but Louisiana has some of the Texas slowness, but has maybe some of its own characteristics there. So that's days on market, right? Time to sell in those homes. What I want to do is let's go into the local markets. Here's Austin. Austin, as I mentioned, is the only market that has less inventory or more inventory than any time in the last 10 years. We have our market action index, which is supply versus demand. We haven't had a true buyer's market in over 10 years. And Austin is like barely positive because it still doesn't have a ton of inventory. There's still some action going, but it's really fascinating to see. Is Austin really, because the buyer competition's falling, does that tick below into the buyer's market sometime soon? Austin home prices are barely they're off the peak from the pandemic and never really recovered. So prices in Austin didn't recover nearly as well as most of the rest of the country this year. And then we can also see in Austin, in our price ranges down here, the market segments, we do every zip code, city, state, and every market into 4 price range segments. The high end of the market may be behaving very differently from the low end. And in Austin, everything is slowing down. Although, the 359K, that's the sweet spot for home buyers all across the country, is the fastest, selling in Austin, but it is still going significantly slower than recent years. Let's contrast that with San Diego. So this is inventory in San Diego. So San Diego is still, its rates are up, but San Diego is still in our strong sellers market, because if you look at inventory climbed last year, but inventory is now back at its pandemic lows in San Diego. Like, who knew that was coming? Inventory is climbing now when normally, see the dot, normally inventory would be falling. So that is, that's a weird dynamic for San Diego, but really very few homes. But here's what I want to point out in San Diego, where the super expensive stuff in San Diego is taking 70 days. Anything under $1 million is still 14 days. And that's even in this rate environment. It's really notable. And so if you're selling in San Diego, or actually many of there's a number of hotter markets around the country, your buyers are saying, I'm going to wait till I get a bargain. And they may not have any idea that the price range that they are searching in is like, if you want this home, you have to make an offer now. They may not have any idea that they're going in a week or two in that price range. Because why would they know? Like, where would you see that demand is up like that? Really surprising. We can look at price decreases in San Diego. Right? It's only 28% of the market has had price reduction. So you can really see where that demand is happening. Let's switch though to Columbus. So this is Columbus, Ohio, and I mentioned how the Midwest and Northeast actually has some of the fastest days on market, and some of the most resiliency in pricing. And we can look at Columbus and see inventory over time and see that we're still in the pandemic lows of inventory restriction. Inventory in Columbus is at its peak probably for the year. So normally would start to fall in November. And so but hasn't yet started falling. So like, we all are adjusting to this rate environment. We can then go look at the price ranges in Columbus, and you can see here's that sweet spot. 350 is the fastest time on market. And what you'll notice is that when rates fall, this 350 and goes, and then this next price range segment will also speed up, because the affordability gets better, and I'm going to move up my notch to the nicer house. Some of the Low end stuff in Columbus is like 80 or 100 years old. It's a 3-1. It is a 1,100 square foot house. And so those take longer again, although they're moving faster than the more expensive stuff in Columbus. So that's something to keep an eye on for some of the Midwestern markets behaving that way. I have Jacksonville open, and I've got price reductions in Jacksonville. So Jacksonville and the Florida markets are not, they adjusted less abruptly than the Western US markets did last year. So you could see the price reductions in Jacksonville kicked up over 50%. And right now they're in the upper 40s. They're still ratcheting up. And so could get there, but Jacksonville is one of these with a lot of new construction. And so inventory can build in there. But let's look at inventory for Jacksonville. We can see more inventory than the pandemic lows, but not yet back to the normal, the pre-pandemic norms. And so again, multiple years of higher rates is what will probably get us back to eventually get more than 5,000 or 6,000 homes on the market in a place like Jacksonville. Let me do one more. Let me do Denver, because Denver was one of the ones that was adjusted very quickly last year, and we could watch mortgage rates, or we could watch price reductions adjust very quickly. But when we look at prices in Denver, we can see that home prices are still up year over year. This is different from Austin, right? Because Austin is down year over year, but Denver is up year over year, but really just back about where it was pre-pandemic and falling right now because affordability is a big deal in Denver and slowing across all price points in Denver as well. So it's a very different market than say San Diego or Austin right now. It's sort of in the middle between those two. We have price reductions. I can switch this to price reductions and see how price reductions are climbing. But last year they were getting to 60%, and right now we're at 50%. So less bearish on home prices in the future, but also likely to see but still kind of bearish, right? There's no home price gains in the next year coming for the Denver market. All right, that's the whirlwind tour of the local markets. Let me share. And as always, I have been talking about the Altos data, how to use the reports, the Altos reports, how to go through and read those lines. If you'd like to do videos like I do, use this the ebook to understand what to read, and it's a really straightforward mechanism for you to just communicate the data. You don't have to editorialize, just communicate the data to your buyers and sellers every week. And really what I recommend is go to altosresearch.com and just get started today. Get your local data, get it rolling so that we can get the reports in your buyers and sellers, get them in their inbox today. Your folks, there's a lot of people who want to buy homes in the US. They're waiting. And so market data in their inbox is the way you communicate being the expert to them so that you're in constant contact with them, so that when the buying environment improves, when rates tick down, when they are ready to take action, they need to be getting your report from you in their inbox every Monday so that they know you are the market expert. So go to altosresearch.com, book that time with our team, or get started today so that you are now setting up your buyers and sellers to be ready to prepare when the market thaws for them. All right, everybody. That's all time we got for this week. Thank you so much. I always appreciate all the attention, and I'll stick around in the chat and we can make sure we get all the last questions answered. Thanks, everybody.